this webinar, we'll be discussing simplifying your investments, exploring the benefits of separately managed accounts. Just a general disclaimer before we begin. So this webinar will contain general information only. So that's information provided in financial products discussed, general advice, and they don't consider your objectives, your financial situation, or your needs. Therefore, you should consider the appropriateness of all information. It is not an invitation to invest, nor is it a recommendation to buy or sell investments. We always recommend that you seek independent advice and ensure you fully understand the risks involved before trading. And finally, we'll also discuss past performance during this webinar. It's very important to note that past performance is not a guarantee of future performance. Investing and trading carry financial risks, so when judging performance, please consider the different types of investments and levels of risk associated. My name is James Woods. I'm one of the portfolio managers here at Rivkin. A little outline of today's webinar. Firstly, we'll discuss what is a separately managed account. We'll discuss what are the benefits of such a structure and what are the risks involved as well. We'll discuss the available investment options for the managed accounts. We'll discuss the costs and look at some examples there. Walk through, if you're interested, how you can get more information or how you can sign up for that product, and just a quick summary. Just a reminder before we begin that this webinar is recorded, so if for any reason you are unable to stay to the end or you'd like to rewatch it later, a copy of this will be emailed out to all attendees. Additionally, we do have some handouts as part of this. On the right hand side of your screen, you should see a section labeled handouts, and in there you can find the PDS and application form relating to the separately managed accounts. So firstly, what is a separately managed account? A separately managed account is an account structure which is set up in the client's name, and this is managed on their behalf by a professional investment manager. It's important to note that those assets are directly owned by the investor. So each client has their own account. The securities, they're held by a custodian. So clients in this case don't have their own individual HIN numbers as you would with your own stockbroking account. The custodian is a third party whose responsibility is to safeguard those assets and hold them. In our case, the custodian and also the administrator and the product manager is Apex. Their custodian is National Australia Bank. A couple of important things to note there. So the separately managed accounts, it's an Apex product, and Rivkin are the investment manager. So we provide the investment advice for their product. Something else to note, clients which may have seen this previously or may have seen it in the news, the Apex, it was recently a takeover. Previously, the company was called Mainstream, so clients might recognize that, but it is now known as Apex following that takeover, and there's a current rebranding going on with that. Investors have the beneficial ownership of those securities that are in the separately managed account. So everything that a client sees in their account is owned 100% by them, which is a little bit different to some of the other investment structures that are out there. And we'll discuss some of those a little bit later. Again, because they have that beneficial ownership, the rights associated with those share ownerships flow through to the investor. So that includes things like dividends and franking credits. So looking at a separately managed account, as we discussed, this is where the account is in the client's name and they have direct beneficial ownership of the assets. Another common way of pooled investments would be through a unit trust or a managed fund, which you may be familiar with. And in this case, the assets are owned and held by the fund, where the investors buy units in the fund and therefore have the exposure to the underlying securities. So it's a little bit of a nuance different there. So in a unit trust, you own the units of the fund, whereas in the separately managed account, you own the shares or investments that are held in there. Just moving on, a couple of the key roles to understand in a separately managed account. First and foremost is the trustee. So with all of these pooled investment products, the trustee's responsibility is to ensure that all other parties are managing and maintaining that product as outlined in the PDS, always to the benefit of the underlying investors. And in this case, Apex SMA product, the trustee is Perpetual. So they're a very large trustee and fund manager, which many of you may be familiar with. The product owner, the product manager, and the administrator for this, as we discussed, that is Apex, formerly Mainstream. And then again, with all of these products, there's generally a third-party investment advisor. And in that case, this is Rivkin Securities. And our role in this is to provide the investment advice to Apex based on the strategies and the objective of each of these separately managed accounts. So again, Perpetual, they're a responsible entity and they're overall responsible for the compliance and the governance of that structure. Apex, formerly Mainstream, are responsible for holding the assets, taking care of the administration relating to the product and performance reporting, and Rivkin are the responsible for the investment selection of those portfolios. So what are some of the key benefits? Firstly, professional investment management. So we actively manage and monitor these portfolios in terms of opportunities that arise or rebalancing. Many of the clients in this or the viewers in this webinar are familiar with Rivkin's retail strategies, where the portfolios are rebalanced generally on a monthly basis. So they're not active intra-month between those rebalance dates. But with the separately managed account, there's always a professional portfolio manager looking and looking for opportunities and taking care of the portfolio management of this product. Again, a key benefit to this that resonates with a lot of clients is that they have the direct beneficial ownership of those investments. They're in their name. It's their account. They're highly transparent and they're highly liquid, particularly for these separately managed accounts. They're all invested in highly liquid, established shares that trade on the exchange, and funds can be made liquid at very short notice. Additionally, they're highly transparent. So clients are able to log into their account, see their holdings at any time, see all transactions that have taken place, have a look at all the fees and charges that have been taken from the account. Whereas in some unit trusts or managed funds, these transactions and some hidden costs aren't always so obvious. So they're a little more or a little less transparent. And it's generally up to the fund to do regular reporting on their holdings. And even at that stage, they may not show all the holdings that are in the fund or all transactions that have taken place. So that's a key benefit for clients that really want to understand and be able to see everything that is going on in their account at any one time. Additionally, because this is the separately managed accounts are managed on a pooled basis, clients have access to institutional level brokerage. And what this means is when we're doing an order, we are generally doing it for dozens or hundreds of accounts at one time. So if we're doing an order for BH Pool and we need to buy 100 shares across 100 accounts, we're pooling that up to one aggregate trade. And because we're doing that one trade at a higher value, we get a cheaper brokerage than clients would normally be able to get trading through a brokerage account themselves. So therefore, there's a reduced cost involved. And again, there's no hidden costs because of the transparency and the access to these accounts. There's no indirect or hidden costs that clients can't see. As mentioned, in some other structures, that can be a little bit of a problem. In terms of administration, this is all taken care of for the clients because you have Apex there and you have the investment manager. So when it comes time for reporting and tax, that's taken care of by the administrator. And then if there's any corporate actions as well, that's also actioned on the client's behalf. So if a company is doing a regular dividend and they also have the option for a dividend reinvestment plan, if a client's holding those in their own trading account, they would then need to determine whether they wanted to receive the dividend or participate in the reinvestment. Or if there's a takeover, that client would need to then go and vote on that. So all those types of corporate actions are taken care of on your behalf. So in terms of actively managing the administration, that's all taken care of for you. So it's less time that's spent on those administrative tasks. Another key benefit being the tax reporting. Again, this is done by the administrator for you. And lastly, tax optimization. So it is important to understand with other pooled structures like a unit trust, when clients buy into that unit, because unit trusts are accumulating capital gains and losses throughout the year, generally when you're buying into that, you're buying into that accumulated level. However, in a separately managed account, it's only based on transactions that relate to you. So buying and selling shares in your account, transfers in, transfers out, and so on. So there are some benefits there, and a more exhaustive list of the benefits and risks can be found in that product disclosure statement, which is in that handout section on the right-hand side of your screen. And we always recommend having a good read through that and fully understand the benefits and risks involved. On the other side, there are risks that we need to consider when it comes to separately managed accounts. As with all investments, it's very important to understand that the capital value may fluctuate, particularly over short-term periods. So, generally when we're looking at what are considered high-risk assets, such as shares, just given the volatility and the potential for loss over a few years, if a client does need to liquidate their account at very short notice and there has been a fall or a drop in the market during that time, then that's important to understand that you would be locking in that loss to redeem. So understanding that the account value can fluctuate, particularly in the short term, is very important. Income and capital gains tax liabilities. So if there's shares being bought and sold, dividends paying, you're hopefully making a profit. If we're paying tax, that means we're doing something right. But those transactions will come with those liabilities. So it's important to understand the impact on your situation. Distributions, regular income into the account. In this case, in the separately managed account, income from dividends and other corporate actions is paid into the separately managed account. And then clients are able to withdraw funds from there if they do need it. But it's important to understand that regular income and distributions are not guaranteed and that they can vary over time. Also need to consider the costs involved. So while we do have access to institutional brokerage, there still is a cost of executing trades in these accounts. There's also management and performance fees to consider as well. These are not exhaustive, and again, always refer to the PDS for a more detailed list of the costs and fees. Minimum investment amounts is another one. Generally, on these separately managed accounts, there is a minimum of 40,000 Australian dollars. The exception is US Growth, which has a higher minimum just due to the currency conversion, which is 70,000 Australian dollars. So relative to opening your own brokerage account and putting $1,000 in there and buying an ETF or one particular share, or doing the same with some unit trusts out there, there is a higher minimum amount for this product. So that's important to consider as well. Additionally, currency risk. while most of these separately managed accounts are Australian dollar based, investing in Australian shares, we do have one which is US Growth that invests in US listed shares, and that is affected by changing currency. So if the Australian dollar were to rise against the US dollar, then the value of the US dollar holdings would decrease and vice versa. So it's very important to understand that firstly, that US product is exposed to movements in the currency. And again, for a more detailed understanding and lists of the risks involved in this, always refer to the PDS. So have a look at a structure comparison here, some of the common types that we do see. We have the separately managed account, we have a managed fund or a unit trust, and then we have direct equities where the client is opening a brokerage account and trading themselves. So in terms of investor control, direct equities, doing it yourself, you have a high degree of control. You're making all of those decisions. A managed fund, on the other hand, has a very low degree of control, while a separately managed account can have, ours don't, sometimes they can have some more customization. And within these products, many of our existing clients don't just have one strategy or separately managed account, they combine multiple of them to have a more diversified portfolio. Costs, so a managed fund typically is the highest here, depending as well whether they're allocating out to other managers, but management fee, performance fee, transaction fees, other ongoing administration fees, they're deemed quite high. In this structure, and a separately managed account probably sits around the middle between the two. And again, direct equities, doing it all yourself, that would have a very low cost because effectively it's just going to be the brokerage that you're paying to execute trades and the time taken to do it yourself. In terms of transparency, we touched on this earlier. Both separately managed accounts and direct equities have a very high degree of transparency, whereas a unit trust and a managed fund are much lower. As I mentioned, within some separately managed accounts, there is the ability to do some customization or allocate across multiple accounts to create a unique exposure in that sense. That doesn't have the ability in a managed fund, and in direct equities, you can make it as highly customized as you like. Again, tax efficiency, we touched on this one earlier as well. Compared to a managed fund, where you're buying into those accumulated gains and losses, in a separately managed account, it's just the transactions relating to you and corporate actions relating to you, so the same as direct equities. One downside is separately managed accounts generally have a higher minimum investment amount compared to unit trusts and direct equities. Both unit trusts and separately managed accounts do get access to wholesale execution. Those brokerage rates will be typically higher in direct equities account. And again, from the administration point of view, when it comes to tax reporting and managing any corporate actions, those are really the benefits of a separately managed account and a managed fund over a direct equities account where you would need to do that administration yourself. So how does it work? Well, firstly, you can sign up to an SMA account, choose the portfolio to follow, and then your funds will be invested according to your selected portfolio, including regular rebalancing by the investment manager. Any benefits associated with that share ownership will accrue in your account, so dividends, franking credits, and so on. And Apex will provide regular performance reporting and analysis of your account, including through an investor portal with live account information. And we'll have the details if you'd like to find out more information at the end of this webinar, and additionally, as I mentioned, in that PDS application form in the handout section. As always, I've mentioned this a few times, please make sure you do read and understand the PDS before investing. And again, always, if you're unsure about what portfolio to follow, always speak to a financial planner or advisor. At Rivkin, we can't provide personal advice, general advice only, but if you do need, we can refer you to a few different planners if you would like to speak with someone. How does the trading work? We touched on this a little bit earlier in terms of pooling orders together to execute. So generally, each portfolio in these separately managed accounts rebalances on a monthly basis. The trading necessary to rebalance the portfolio, that's taken care of by you, by Apex. Riv can provide them the investment advice, and then Apex aggregate and execute the orders. Those aggregate orders across all client accounts are pooled together. And by doing a larger trading size, we get better access to brokerage rates compared to what you typically see in a retail brokerage account. So say we have 3 clients, one's buying 1,000 BHP, the other's buying 500, and the third is buying 100. In total, we have 1,600 BHP shares. So those 1,600 shares are then bought in one lot on market, and the brokerage rate on that is about 5.5 basis points. And typically in a retail brokerage account, you're paying around 11 basis points, and it's generally subject to a fixed dollar minimum. And once that is executed, then Apex, as the administrator, able to then allocate the required units to each client. What are the available investment options? We have 4 portfolios. So there's ASX Income, which focuses on large cap diversified equities with a strong focus on regular income over capital growth. We have US Growth. This is for clients that are really looking for more capital upside and are willing to tolerate some higher volatility as a result of that. And within that, we're focusing on the the largest 100 to 200 US listed stocks. So many names that clients would be familiar with. Low volatility. This one is a little different in that it's not a share only portfolio. We use ETFs. So it's a little bit of an all-weather portfolio whereby we use ETFs to have diversified exposure across multiple asset classes. And we look at equities, we look at fixed income, we look at cash, and we look at alternatives and commodities such as gold. And the reason we do that is because these asset classes tend to move in different directions over different times. They have a low correlation with each other. So they provide a diversification benefit and therefore generally less volatility than we would see in an equity only portfolio. And finally, we have our version of ASX Growth. Again, this is for investors who are willing to tolerate some higher volatility because they're more focused on growing the value and the capital in that portfolio. And within this, we're looking at the 100 largest listed stocks, or 100 to 200 largest listed stocks on the ASX. So starting with ASX Income, this is probably our most popular one. And that's because it combines a blend of 2 strategies, which are really flagship strategies that we've had in the retail portfolios here at Rivkin for over 20 years. That's focusing on high dividend yielding stocks and event-driven trades. So things like takeovers and other types of corporate actions. And within this, we take a core satellite approach. And what we mean by that is we divide the portfolio into 2 sections. The core represents the bulk of the portfolio, currently sits around 70%. And that's invested in high dividend, highly liquid, established and profitable blue chip stocks. And the purpose of that is to generate consistent income and also provide enough market exposure to equities, which we historically over the long run have provided some of the largest returns. And then to minimize some of that volatility that we get from long-only equities, another flagship product that we've always run here is events. So the main focus of this is takeovers, but we do look at other corporate actions such as buybacks. And these takeovers tend to be or have very low correlation with other equities, in that there's generally a binding takeover offer on the table, so we see minimal volatility in those stocks. We look for compelling annualized returns. Often we might be holding for a 2 to 3 or a 4 month period, but the annualized return on those takeovers might sit at around 8%. So within that portfolio, we're combining some of our most popular strategies and we're adding to diversification. As I mentioned, large cap, high dividend shares, and it's really a blend of income and capital growth, but the main focus is on generating income. And then when that income is paid into the separately managed account, if needed, that can be withdrawn by investors, or that money can be actively reinvested by us to help compound the value of that account. And generally, if we're talking about equities, often we're talking about more growth-related stocks versus established stocks. Because we're investing in those highly liquid, large cap blue chip stocks, they tend to exhibit a lower level of volatility compared with some of the smaller, more growth-orientated stocks. And over the last 12 months, that's generated a return slightly above 9%. So based on the blend here of around 70-30 between blue chips and takeovers. And this isn't a product that we expect to consistently outperform the ASX 200 because we're not fully invested in long-only equities all the time. And as a result, the real benefit from something like this comes in that the portfolio exhibits lower volatility and particularly lower drawdowns. So when the market is up, we expect to be up, but by less than what the market is up. And then when the market is down, we also expect that we probably will be down as well, but by less than the market has fallen. And this is just to show you the past 12 months of performance for the ASX Income separately managed account. Again, just to reiterate, past performance is not a reliable indicator of future performance, just to understand those disclaimers earlier. Next, on to ASX Growth. So as I mentioned, this focuses on the largest 100 to 200 stocks listed in Australia. Really, the focus here is on capital appreciation because we do have exposure to smaller capitalization stocks compared with, the top 20 largest listed stocks. So we are focusing on growth over the long run, and therefore a portfolio like this tends to have a higher level of volatility than, say, the ASX Income product. Within this, we combine two strategies that we've run here for several years, value and momentum, with the value-based strategy using fundamental data, looking at valuations, looking at dividend yield and return on capital employed. And what we're really looking for is financially sound, profitable companies that have some growth-like characteristics to them. And then we're also adding in, momentum-based buys in there, and that's technical-based. And the reason we want to combine these two strategies, really the value factor and the momentum factor, individually they can be very volatile and concentrated, and they tend to move differently at different times. So again, there's a relatively low level of correlation between them. So when we combine them, what we're getting is a bit of more diversification within the portfolio. So, if the value stocks are doing well, the momentum stocks might be lagging a bit, and we end up with a more blended return and vice versa. And over the last 12 months, that returned 12.77% net of fees. And with that portfolio, it's generally an even split. Our strategic allocation is 50-50 between the two strategies. But over time, that allocation will change as one strategy starts to outperform on a relative basis. And that's where we'll actively manage the portfolio in terms of rebalancing that and bringing it back to target weight. And just to show you how that's performed over the past 12 months. And as you can see, compared to ASX Income, yes, it has generated a higher return, but that's come with more volatility along that journey. Over to US growth. So this is the US focused version in the same concept of ASX growth. It looks for the 100 to 200 largest stocks listed in the United States. Again, that focuses on long-term capital appreciation because we want exposure to growth stocks, which tend to come with more volatility. So we are targeting higher returns, but as a result, we do see higher levels of volatility. Again, it combines value and momentum. So we are looking at strategies which are unrelated to each other and add diversification to the portfolio. And over the past 12 months, had a fantastic return, 20.73% net of fees. And again, it's a 50-50 split in terms of the allocation between value and momentum. We have been running these for several years, and in our experience, they tend to move differently at different times. As an example, in 2020, momentum stocks had a fantastic year as part of that COVID rebound, while value stocks lagged. And so we ended up with a blend of the return there. And then, we did see a big reversal of that. In 2022, momentum stocks really struggled. However, value stocks, as a component of the portfolio, actually rose to a new all-time high. So we're ending up with nice diversification within there to help smooth out some of the volatility. And just as a reminder that the US growth portfolio, as it stands today, is unhedged to currency risk. So if the Australian dollar rises against the US dollar, then that's going to have a negative impact on the account, and vice versa. If the Australian dollar falls against the US dollar, then that's actually going to have a beneficial benefit to the account. And just to show you how that has performed over the past 12 months as well. Finally, onto the fourth portfolio, which is low volatility. So it's a diversified multi-asset portfolio. The purpose of this is to have something that is a little bit all-weather, in that it's a diversified portfolio that should be able to see you through and generate relatively consistent returns regardless of what is happening in the world in terms of economic cycle, whether there's a boom, whether there's a bust, whether there's geopolitical tensions, whether we have high inflation, low inflation, changes in central bank interest rates. The diversified nature of this and exposure to different asset classes is designed to help you through those periods. With this, we do see lower levels of volatility and drawdown risk. So when we're talking about drawdown risk, declines in account value from highs versus long-only equity portfolios. So with something like this, we expect to see lower downside risk, lower levels of volatility versus long-only equity portfolios. But over the long run, we generally expect to have more modest, consistent returns in something like this. Over the past 12 months, net of fees, 7.32%. And as I mentioned earlier, we look at 4 asset classes here. We look at equities, we look at fixed income or bonds, cash, and alternatives and commodities such as gold. And our target allocation is actually an even split, 25% across all these asset classes. And exposure is achieved through highly liquid ETFs that are listed and traded here in Australia. And over the past 12 months, compared to the other portfolios, you can see that this has shown less swings month to month on a basis. So we do have lower levels of volatility with something like this. But as I said, over the long run, this isn't about trying to achieve the highest returns possible. This is to have a nice diversified all-weather type portfolio just to get you through whatever is happening in the world. It's important to understand the fees and charges. So a little summary table for you here of the management and performance fees. So across ASX Income, ASX Growth, and US Growth, they all have a 1.55% management fee, inclusive of GST, while low volatility, which is a less actively managed portfolio, has a 1% management fee. And then there's a performance fee. Again, ASX Income, ASX Growth, and US Growth have a 10.5% performance fee, and low volatility, being less actively managed, has a 5% performance fee. So there's no upfront costs. All of those costs are bundled into the management and performance fee. These fees, they're a percentage. So management fee is levied against the total value of the account and taken on a monthly basis. Portfolio fees are also assessed on a monthly basis, but it's important to note that a fee is only charged on profits made above a high watermark. And what that means is, for any performance fees to be generated, your portfolio has to exceed its highest value ever. So if the portfolio starts at 100,000 and by the end of the next month it's made a 10% return and it's sitting at 110,000, then in the case of ASX Income, that 10.5% performance fee would be applied to the profit, which is 10,000. So you'd be looking at $1,050. And then that's taken into account setting your new high watermark a little bit below 109,000. And what that means is, unless the portfolio value then exceeds that level, no performance fees are charged. So that's why we have a high watermark, to ensure that it's only paid against new performance on profits. Just comparing those portfolios in a little bit more detail for you. So in terms of the management fee, 1.55 across the growth portfolios, ASX Income, and then 1% across low volatility. The performance fee, 10.5% across ASX Growth, US Growth, ASX Income, while low volatility, less actively managed, at 5%. Recommended time frame based on the PDS. So the two growth portfolios, 4 to 5 years, just given the levels of volatility. ASX Income being less volatile than the two growth portfolios is 3 to 4 years, and then low volatility, 1 to 2 years. And there's actually a really fantastic website which is run by the Australian government called Smart Money, and they have a lot of great resources which are worth reading through, but they also talk about standardized risk measures, which you can see down the bottom here, and the benefits and risks involved in that, always worth having a look at. The minimum investment amounts, so for ASX Growth, ASX Income, and low volatility, they're all 40,000 Australian dollars, while US Growth, because we need to convert to US dollars and we want to make it efficient in terms of brokerage that's going to be charged for a minimum amount per share, that has a high minimum amount of $70,000. And then estimated transaction costs based on turnover and trades and brokerage is around 0.5% per annum on ASX Growth, US Growth, and ASX Income. And low volatility, much less actively managed, a lot less trades going on, and that's estimated around 0.3% per annum. Just to have a more detailed look at how those expenses and those costs work. If we have this is just a made up example here for ASX Growth, we start a portfolio at 100,000 and by the end of the year it's up 10%, so its value has grown to 110,000. Taking the management fee on a monthly basis would equate to a little over $1,600. And as I mentioned, that performance fee would be charged on the profit only. So 10.5% of the 10,000 made equates to a little over $1,000. And then estimated transaction costs of 500 would bring the total to a little over 3,000. So the dollar return net of fees would be 106,816, or a 6.82% return. So always really important to understand the benefits and the costs involved, and always refer to the PDS for more detailed information. As I mentioned at the beginning, to access this, you can, for more information, you give us a call, 1300 748 546, Alternatively, you can email us at sma@rivkin.com.au. Please do remember to download in the handout section on the right-hand side of your screen. That's where you access the product disclosure statement, the application form, and more detailed portfolio descriptions. As I mentioned, please do keep an eye out. We will send a copy of this webinar, so if you'd like to watch it again, you'll receive it by email. If you have any more questions, you can contact us on the phone number in front of you or the email address as well. Please also do keep an eye out for our post-webinar survey. We take on board your feedback into the types of webinars and the information we cover. So please do keep an eye out for that. Otherwise, thank you very much for attending today's webinar.